We are live. The high risk growth strategy is now up 237% year to date, even with the crypto crash last Friday. This turned every $10,000 invested into $37,300 so far this year. And I'm expecting a melt up through December into summer of next year. We have two strategies to follow: the high risk growth portfolio. Currently had a little pullback in December, otherwise we'd be up closer to 300%. But again, this was all very bullish news. We'll talk about it. Our safe growth strategy is now up 27% year to date, down 1.5% in December. That was this morning. Everything's melting back up as anticipated. So we're down less. We'll look at the live track record in a minute. The Bitcoin 20% flash crash was bullish. What happened was a big whale saw a bunch of leveraged minnows, we'll call them minnows, little retail traders who were using leverage. And it was a brilliant move. They dumped crypto while everyone was out Friday night, caused 440,000 accounts to go to zero, and then swooped up all their Bitcoin at 43 grand. What a move. This is very, very bullish. Get ready for the next melt up ahead. The new variant that the markets are getting scared about, or at least the media is trying to scare you about, is very, very bullish. This is not going to, this is all very good news because this is going to delay how quickly the Fed's going to tighten. The pathetic 200,000 job gain in November last week, bullish, more ammunition to slow down the hawkish Fed. We've got corporations lining up trillions in stock buybacks. Biden's getting ready to push trillions in new stimulus through. China just dropped interest rates 50 basis points, and they're getting ready to pump money into the economy. Turkey's lira needs to be bailed out. It will be bailed out. It keeps going into hyperinflation. The bailout will push the dollar down and be extremely bullish for how we're positioned. I'm expecting a dovish Fed surprise December 15th. They have an FOMC minute 13th through the 15th. Right now, we've got signaling and whispering that they're going to double the tightening in January and do 3 rate hikes next year. That would be the equivalent of raising interest rates 5 notches higher, which I believe would completely collapse markets. I believe this is all a big bluff to try to slow down inflation. So what are we looking at? Cash is trash. We're running twin deficits, massive twin deficits. What is that? Our trade balance is highly negative. We import way more than we export, and our government's spending trillions they don't have. This is net negative on cash. Bonds are garbage. Their interest rates are way below inflation. So until the inflation is turned down, this is another bad investment. Investors have no other logical option. So we're issuing a buy trade alert, red hot trade alert. This is perfect timing to get started with our portfolio. I know this buy trade alert confuses members. If you're invested, there's no change to your portfolio. Sit back, enjoy the ride. We're looking for a melt up Christmas rally. Stocks, crypto, and commodities are likely to melt up all the way until June with stimulus passing and the Fed slowing down this hawkish rhetoric. That's what we're anticipating currently. Now, we're still going to be dealing with a massive fiscal cliff around Q3 next year. So we'll see how we're going to have to adapt for that. But it's going to be all based on the job data, whether or not it's weak or strong. If Biden's Build Back Better plan is blocked, the market could crash for 1 to 2 months max, and then they're going to push that through while no one's looking. So another good news is the debt ceiling was pushed with short-term bill, which gives Congress until January 15th to get this through. So the House is ready to pass all this stuff through. It's really the Senate holding the spending back. A failure to close a deal in December and January very likely will create volatility by January. And UVXY is our hedge against this risk. Now in March, when we got a 30% black swan crash event on the S&P 500, the UVXY went flying up over 1,000% in 4 weeks. The market could now fall, well, at least a few weeks ago, it's gone down a bit, and I believe it's going to not go any lower from here. If it did fall back to the February high, we were looking at a 40% decline. If we go below that, back towards March levels, the potential returns on UVXY are above 2,000%. So if you've got around a 7 to 12% UVXY position, you're extremely protected against volatility, and we'd want to sell that and buy into the dip. Now may be the best time ever to follow our high risk growth and safe growth strategy. I really like putting 70% of your money in the safe growth and 30% in the high risk. Big picture, we're looking at an inflation cycle led by energy companies going up, interest rates rising. Just a little repeat of history here. If we look at the dot-com bubble, as soon as they started to expand deficits, we got a 5-year bull market in energy. And this led to interest rates rising and the housing bubble popping. Next round, we went to double the deficit spending. We did really aggressive quantitative easing, suppressing bonds, making them unattractive. Guess what? You got inflation all the way up until the Trump era. And so that was another 7-year cycle. So what do we expect when stimulus passes? I'm going to expect the foreign stock markets to outperform US markets, the exact opposite of what we've seen over the last 10 months while the Congress has been unable to pass any budgets and the dollar's been going up. The second they pass this, expect the dollar to go down, interest rates to rise, and another growth to value rotation. Last time we passed 3 trillion in stimulus was December, 1 trillion with Trump, and then January, late January with Biden, 2 trillion. And immediately, foreign stock markets dominated returns against US markets. That's why our safe growth strategy gives you a global portfolio. We're not going to put all your eggs in one basket. Emerging markets outperformed the US by 50%. Now, we had some problems last year. The government failed to pass its main budget, which is the Build Back Better plan. Global economies had lockdowns rolling out all summer. Interest rates came back down. The dollar has risen, and the US failed to recover its labor market. So again, that was last year. Let's look into the future. I'm expecting jobs to come back online, lockdowns to start to really disappear, and for China to take the wheel in terms of increasing credit in its economy while the US is going to relatively slow down. So get ready for interest rates to rise, growth to rotate into value. It means your tech stocks are likely going to have not the exciting return you're used to, and the boring old banks and energy companies are going to take off like a firework. Now, here's a reminder of what you need to be worried about, and it's really when interest rates rate of change go up too quickly. Okay, we've seen tech and energy go up together, but it's when those interest rates start to rise too rapidly that we get the volatility in growth stocks. So in the yellow line, we can look at the triple T. That means interest rates are going up. We can look at the energy companies, XLE, that represents the value, and then the growth in the NASDAQ. And when those interest rates went rising up rapidly, tech sold off, value got the bid. Now, again, this all reversed course due to lockdowns, failure to pass more stimulus, no labor recovery, and then again, China went on this huge agenda to try to spread out the wealth of China and clean up their economy and pop a lot of bubbles. But are they going to do that forever, or are they getting ready to print money like nobody's business? Now, as the job market recovers, this will also continue to drive this long-term prediction. So all eyes are going to really be focused on the job market here on out. That will likely dictate how hawkish the Federal Reserve will become and how bad this fiscal cliff is going to be on the economy come next year. So don't miss out on our next trade alert. get access to the membership area, call Dean right now, 505-322-7515. He can analyze your portfolio and tell you how to get started with our product right away. Now, really quickly, a extra bonus when you do join is you'll become qualified to become a Rebel Dividends private equity investor. We did have a bit of a pullback due to crypto taking a nosedive. It's rebounding. We're not worried whatsoever. Share price is now at $1.13 with 1 million shares outstanding and a $1.1 million value of the assets being held currently. This is again only available legally to paid portfolio builder members. Okay, so you can't have access to this unless you do that. Now we're also currently onboarding over $600,000 worth of new shares that are not yet accounted for in the screenshot we just showed you. And there's a lot of money coming in right now. The portfolio for Rebel Dividends is currently along the following assets. We have UVXY for crash insurance. We're hedging against interest rates with NRGU. We currently own GBTC and ETHE for Bitcoin Ethereum exposure. We're long the competitors to Ethereum, which are Cardano, Solana, Polkadot. We're generating massive income to pay out over a 1% monthly dividend using a DeFi exchange named Pancake Swap. It's a protocol based on Binance, by far the dominant cryptocurrency exchange globally. And then finally, we have a position in Polygon. Now, we do have some planned changes coming to the corporation's portfolio. We're going to be exiting GBTC, ETHE, and NRGU, which are all at Interactive Broker. And we're going to start getting more aggressive as a market maker at 8 different decentralized exchanges. This is going to allow us to have exposure to not only what I call the operating systems, which is Ethereum, Cardano, Polkadot, etc., but also the hot software applications that can have exponential growth. So by being a market maker, we're going to give you exposure to the hottest assets, and we're going to be able to collect consistent profits from trading fees by becoming a market maker. Here's a look at where we're going to be allocating capital as we slowly transition into this. And a lot of the hiccups for this company has been simply banks do not want us to get the money out of their financial system into the new world financial system. So we're getting around these problems slowly but surely, and we're going to be giving you exposure in the most aggressive way possible off the grid in the following different smart contract chains. So these are the best decentralized exchanges where we can be a market maker. We can have exposure to the base coin plus the applications being designed on those operating systems. So we're actually going to be far more aggressive than the high risk strategy while still creating very, very attractive dividends. Right now, we're promising a 1% monthly dividend, but I think by March, we'll be up to a 3% monthly dividend, which is unheard of, while holding assets that can go up tenfold in the coming years. So these are the hot dexes. These dominate the space we have with Polygon, the quick swap exchange. With Ethereum, the dominant player is Uniswap. The secondary player is SushiSwap. With Cardano, they're launching Sunday Swap. It's not live yet, but it will be soon. With Solana, it is Radium. With Polkadot, it's Polkadex. We're already having great results over with Pancake Swap, which operates on the Binance Smart Chain. And then Trader Joe XYZ is the Avalanche, and excuse the name, it's not Polygon, that's Avalanche. So these are all the smart contract platforms that are going to drive the blockchain success. And I think it's going to take several decades to really hit peak profits. And that's just looking at how long it took for companies like Amazon, Netflix, Google to really saturate their market, or even come close to saturating. They're still growing faster than just about any company on the planet, and that's after decades of growth. Now, I'm also going to switch out our hedging strategy from being long UVXY to buying put options that are out of the money on specific tickers like Marathon Technologies. So we'll look at those charts and why this could be a much more effective way to hedge our portfolio. Now, if you want to invest, again, you do have to be a paid member to qualify, and you can call my father, Victor, who's your Chief Support Officer for Portfolio Builder, to book a call. So write his number down now, text him, call him. He does both, 505-203-0396. Okay, very good, guys. We're going to jump into the meat of the presentation shortly here. Let's see what we have coming through the chat box. Let's see. Mike says, what was up with the crypto panic? That was big whales taking advantage of retail. Anytime they see a bunch of people leveraged up, they're going to go ahead and dump, create automated forced liquidations, and then they can swoop up your coins on the cheap. So really, really fun to watch that play out. Okay, Oscar's interested. Okay, great. Oscar will get you, and you know my cell phone personally, Oscar. So, but yeah, my schedule is getting slammed with bookings. So it'd be good for Victor to put you on there. Okay, Steven says, I presume Rebel dividend. Yeah, so what I don't want to do with Rebel dividends is hold assets that you can easily do on your own. What really makes sense for Rebel dividends is for me to buy the assets that are complex, risky, and hard to do safely. So you can hold your own GBTC and ETHE with our two stock-based recommendation portfolios. What you want me to do is go create consistent income for you in retirement, hold as little of your money as possible, and give you as much of it back every single month as a monthly dividend. And we're getting ready to move Ryan to Puerto Rico so that we don't have to pay short-term capital gains on all this short-term profit we can make as a market maker. Sass says, hey, Jason, you're planning to exit UVXY? No, that's not what I said. So Rebel Dividends is going to do a more advanced hedging strategy for crypto. Portfolio Builder will continue to use UVXY. So yeah, not dumping the hedging. We're up to 60 live, a lot of people coming in right now. All right, guys, so let's go ahead and look at our report card. Safe growth is up 27.9% year to date. A little bit of a drawdown December. This is our global stock strategy. Then our high risk strategy had a pullback due to the volatility Friday, still up 280% year to date. Buy that dip, guys. There's nowhere else to put your money. Now, if you're doing a combo 70-30, you're looking at 101% year to date return and down about 4.5% in November. Now, again, when you upgrade, you're going to get access to the calculator where you can punch in how much you want to invest, and it does all the math for you. It tells you exactly what to buy and how many of each ETF. And it's because of this strategy, our members are easily able to get very similar returns over time. Okay, very good. So that's the snapshot. Real quick, if you are getting ready to look at the high risk growth portfolio, make sure you write down Dean's phone number. If you want a custom screenshot to invest in an amount that's different than 10,000, just call Dean. He can walk it through you. Maybe you want to do 20K, 50K, whatever it is, just call Dean, 505-322-7515. He can take care of you. All right, let's get into the meat of the conversation now. So real quickly, let's look at crypto. I know that's a very hot topic for our member base. These are the current assets we're tracking for Rebel dividends, and it plays into portfolio builders as well. So here's that dip right here. You can see last Friday, I was watching it live. And so, yeah, we got about a 20% decline in Bitcoin, up to 30% in some of the altcoins. And this was done on design. They saw a lot of leveraged players, and they were easily able to wipe them out. This is why I would never lend my Bitcoin to something like BlockFi or Celsius. Had this gone down another 10 to 20%, In my opinion, all the money at those two locations could have been completely wiped out. So it's complex to explain. But yeah, I would not be lending my Bitcoin out for a loan, as I do think you could lose your entire base capital. So we're not doing that. Don't recommend it. And this just shows you how easily someone can manipulate these markets. This is why we don't have stop losses. Stop losses and people on margin got completely obliterated in a matter of an hour last Friday. So again, this is bullish. All that leverage is wiped out. The big boys bought the dip. And now we're getting ready for, in my opinion, the next big melt up higher. A quick look at the performance of some of these assets over the last week. We can see Polygon. Let's see, yeah, that's about a week back. So Polygon, ticker Matic up 27%, UVXY up 16. The oil hedge 2.7. Ethereum over the week down 3%. Now, fascinating, Ethereum is now having better returns to the upside than Bitcoin and less drawdown on the downside. Is it going to become the largest market cap and overtake and dethrone Bitcoin? It very well likely could. So we're paying close attention to that. Some of the competitors for Ethereum are still at a great discount, and you want to buy that dip. Solana really giving Ethereum a run for its money, probably the only asset really outperforming Ethereum consistently. Cardano, love its setup. It's been having a little bit of a hard time keeping up with Solana lately, down 15%. PancakeSwap is now burning tokens. It's starting to get a nice bid. You can see that in green with it rallying right here. But over that period, down 15%. And Polkadot just getting slaughtered, down 27 by that dip. I love to get good assets at a discount. All right, let's talk hedging strategy. For Rebel dividends and potentially as a bonus in the high risk strategy, you can do a little bit better job against the volatility in crypto by buying put options on companies like Marathon Technologies. So if I zoom out, we can see that Marathon has actually outperformed Ethereum. It's a Bitcoin mining company, and it is extremely volatile. It outperforms crypto to the upside, and when it tanks harder than the underlying assets, and that's exactly what we want. So watch for a put option on companies like Marathon at the right time. Right now is the worst time, so we're not going to be issuing that trade alert currently. So that is one of the companies that Rebel Dividends will do it for, and probably the only company I would recommend to portfolio builder members. But I have a whole basket of these type of stocks, so we can have a diversified set of put options protecting Rebel Dividend investors, which will be as aggressively as possible invested in these different operating systems of the future. So very, very exciting. And then again, here's a look at the volume, the open interests, the strikes of Marathon Technologies. So again, that'll be a bonus, and it can replace your UVXY. When the right time emerges, I will start to add that into the high risk portfolio. Not everybody can trade options, so it's going to be optional. We want to keep Portfolio Builder as easy as possible to follow. Okay, very good. So let's go ahead and pull up the main data we want to look at. Okay, so the big fear is the Fed's going to speed up QE. They're going to double the speed of tapering in January. That's what they're signaling. Now, I think the new mutant variant is going to slow down those plans. We had a weak jobs report, and we're likely going to see cases, maybe not hospitalizations, but cases going parabolic within 3 weeks. So just watch it play out. This is going to be what we need to get central banks to slow down all this hawkish rhetoric. I think all the talk was just that, talk to slow down inflation, because inflation means government should slow down its spending, and that's what is the worst nightmare of a government, slowing down all the crooked spending they love to do. So Goldman Sachs is out telling us that they're going to do this doubling of the tapering in January. and that they're going to hike rates 3 times next year ahead of midterm elections. I'm calling BS. I don't think they will do it. If they do it, I'm quite certain it will crash everything and lead to even more aggressive QE. So we'll have our hedge in place. We're ready for it. If it really looks like a crash is going to occur, don't worry. We will short the hell out of this market and then buy that dip with big fat smile. But right now, the bond market primarily is predicting this through the 2-year, happening around June. Previously, this was expected to begin in July. So that's where the first rate hike is expected, and that we may even be beating that timeline and hitting the second rate hike by June. Now, Morgan Stanley and a lot of the other banks are saying this is all nonsense. The tightening will begin in January of 2023 after politics gets out of the way. So as you know, that's my main specialty, is trying to predict the politicians and the central banks. And I think the job data is going to really be important, less so than the inflation. Now, there's an interesting correlation to the level of inflation and Biden's polling. So I think that's why there's a sudden switch. They realize they have to cool off the inflation. Otherwise, they're going to have no chance at the midterms. But on the other hand, if they tighten too quickly, the labor market crashes, the stock market crashes, and they're probably even worse off than current. So the Fed is trapped. All right, let's look at the yield curve. On the x-axis, we have how long you're going to lend money to the government. On the y-axis, we have the interest rate the government's going to pay you. In black, we're looking at October, before Trump started passing stimulus, and then Biden. In the green line, we have the effect of passing $3 trillion in stimulus. Interest rates went rocketing higher, and you got that growth to value rotation. And then in blue, we have the effect of not passing stimulus since February. So what do you see? You see these poor interest rates are falling. And more interesting, the 2-year has gone parabolic. So the yield curve is flattening. This is telling us that the bond market thinks there's too much inflation relative to short-term interest rates, and those are rising, that the Fed needs to push those rates higher by raising rates, but that if they do it, you're going to crash everything right now. So this is an unhealthy yield curve to tighten, and I don't think they will do it successfully. You got to get some massive jobs online really quickly. Otherwise, the US is going to have problems into next year. So that's what the bond market's telling us. The VIX is, oh, wow, okay, that's, we got the big jump now between December and January. Friday was actually sloping down, but the VIX is pulling back 11% today. So it's back to a more normal shape. The risk is clearly between now and January. We got to pass the Build Back Better budget. We need to avoid getting too hawkish. Okay, that's why we're seeing this big jump between December and January. And again, where there's a big jump, that's the riskiest periods where there's hedging taking place. Okay, the reverse repo is a bullish indicator for growth assets. The bigger the number, the better it is. This means interest rates are unlikely to spiral out of control as long as there's a high level of reverse repo. It's at $1.48 trillion. Very bullish, okay? No reason to freak out and sell all your tech stocks right now. So very good on that front. Here's a look at macroeconomics in one chart. In gray, we have interest rates. In green, we have energy with NRGU. We call that the value sector. And then we have our growth with the NASDAQ. And it's just fascinating to see how this always plays out. If rates go down, growth goes up, value goes down. Okay, and what do we believe is about to happen? Bunch of spending is going to come through, jobs are going to recover, rates are going to go up, value sector goes up and outperforms growth. That's what we're anticipating as the big picture. Okay, here we're looking at the Russell 2000. It really needs the spending to go through. It was trading flat all year, and then broke out in November. It pulled back, and I believe it will continue to travel higher. And again, the big catalyst will be passing more spending. Now in this chart, we're looking at emerging markets. China has been really given this one a tough time this year. But in general, I believe emerging markets will be your best performing index this decade for a multitude of reasons. They're getting ready to increase spending while the US is getting ready to relatively slow down credit. So that's all you need to know. In the pro strategy, the safe growth strategy, we're 25% of our account longed a leveraged emerging market play. Now, only a third of that's China. You're getting India, South Korea, Vietnam, Taiwan, just a massive basket of over 4,000 companies held in that one ETF. It's a beautiful play. These companies are at a great discount. If we're going to crash, emerging markets will crash way less than US. And if we're going to pass spending and rally higher, the dollar's going to fall, and emerging markets are highly likely to outperform everything under the sun. So really recommend you get that safe growth strategy built out today. Now, the big bank position and the play on rates going up is getting involved with Europe. It's been a great index EFO. We're playing EFA because you get 2 times your money. And again, looking for this to break higher with spending passing. This chart, we're comparing Bitcoin to Ethereum, mainly to decide what makes the most sense for our high risk strategy. And Ethereum is kicking Bitcoin's butt. It's got faster volume growth. It has faster user growth. It has better returns to the upside, and recently less volatility to the downside. It has a huge bullish catalyst coming. And that bullish catalyst is that it's switching to proof of stake, which is critical because it's really garbage technology compared to Solana, Cardano, Polkadot currently. And even the Binance Smart Chain blows away Ethereum in terms of being able to create software with low transaction costs. Right now, to do anything on the Ethereum blockchain is outrageous. Okay, and Ed says, is the delisting risk real? Well, they just want to move it to Hong Kong. So yeah, emerging markets already buying assets that are not in the US stock market. So we could care less if they want to move Alibaba from the US to Hong Kong. Don't care. Okay, gold and silver continue to be a dud. For these guys to really play out, we need the labor recovery to fail. It's just too early to tell. Lockdowns and mutations and mandates and all sorts of garbage have been convoluting whether or not the US will be able to recover. The big problem is the labor force participation rate is not going up. We've lost 5 million jobs, maybe permanently. So we need to see how this plays out. For your gold and silver to play out, you want the government to continue suppressing bond yields because the economy is inefficient, weak, and labor's not recovering. If we're going to recover labor, watch out. Gold and silver could really underperform some of the other energy and commodity plays we have in place. Okay, in this chart, we're looking at crash plays. We have UVXY is the only one that makes a whole lot of sense. But it's very volatile, so we're very skittish to add to that position. EUO is the dollar against the euro. And again, I believe that's getting ready to fall. So I wouldn't put money in that. And then we have TMF, that's the bond market. That one makes no sense whatsoever. The only way the bonds go up from here is we fail to pass this budget, in my opinion, and we get a stock crash. And if that's going to happen, I'd rather play UVXY. So that's how we're looking at that. Right now, UVXY is the only hedge that makes a whole lot of sense because cash is trash, bonds are garbage. The VIX is your way to hedge. Okay, some other little plays we have. Okay, I'm going to take off MJ. We're out of MJ and we're out of TAN. We're also not playing COPEX, and we're not in the carbon credits. And I will add in BOIL. So getting ready to add to the BOIL position. Good thing we waited a bit, but I believe it's about time to buy that dip. We like and we're out of F and GU now. So the plays we're looking at here are REMX, that's lithium, cobalt. That one's a surefire winner for several decades ahead. We need to increase lithium output by 20 times just to keep up with the electric vehicle. And then if you look at how much lithium we need to mine, realize that has to be mined with machinery that uses oil. So yeah, we love all these inflation plays. I'll throw up NRGU. So our favorite inflation plays are NRGU. That's your top 10 US big oil gas companies. It's really good because this specific government has really set up a monopoly for our big oil and gas companies to drive oil higher and to prevent anyone else in the US from opening up new rigs. So this is a perfect setup for NRGU. These guys are gonna make more money than they've ever made in history. Very bullish there. We like REMX to be long cobalt, lithium, and a bunch of other rare earth metals for tech to really power all these electric vehicles that we want to put on the planet. Right now we're powering them with coal plants. What a joke. We have to get nuclear power up. So this is a long-term play with uranium. BOIL is going to be a playthrough winner. Getting ready to double down on that. Maybe triple down on that for the high risk strategy. After we exit that, look to play agriculture. The ammonia is now up some ridiculous amount, which is used to create fertilizer. So fertilizer costs are going up tenfold for the new crops. We're going to be playing probably a wheat play next year after we exit BOIL as the next hyperinflation that's going to hit the global economy. So get ready for some more action for high risk. Okay, when should we dump our commodity plays? As soon as we retest that low. So as soon as DXY heads towards 90, we'll pull a lot of profits, maybe even completely exit those positions, and then get ready to buy the next dip. So what's causing the dollar to go up? It is this. Let me pull up the lira right here. This single currency is driving the dollar higher. As soon as they bail out the Turkish lira, expect the dollar to come down. The other catalyst will be the US passing its spending. And funny enough, when China ramps up its spending, you'd think it would make the dollar go higher, but we're seeing the exact opposite. It's likely to make the dollar go down and strengthen the Chinese economy. So that will be a great indicator of when to pull profits on our energy plays as soon as that dollar dumps. And mainly I'm looking at REMX and NRG, which are large positions for us. BOIL will time more relative to the winner. Steven says, who will bail out the Turkish lira? The IMF. Okay, now everybody's been worried about China's real estate. Big real estate companies are going bust. They're not paying their bonds. Potentially some of these bonds are held by Tether, which is a risk for the crypto market. And it's a legitimate risk. If we think China is going to have a big problem, they probably start to devalue their currency or crash their stock market. And today we have emerging markets above 48, a line in the sand. We've got Alibaba bouncing. It was up 10% this morning, and their currency remains strong at 6.3. So if we zoom out, you can see just how strong their currency's become. So China is doing just perfectly fine. Here's NRGU. It's very volatile. I'm expecting this to go towards 600 before we're going to be getting nervous. So a long way to go there. Now, before you start using technical analysis on a 3-time levered product, realize those can be very misleading. Instead, let's just focus on the biggest US oil player, Exxon. I believe they are going to be making more money in the next 10 years than they ever have in the history of the company. Okay, and especially during this administration's reign. Maybe things change if different people come into power in politics, but we'll worry about that when we get closer. For now, as long as Exxon's below 90, we want to be owning this asset class aggressively. And if it breaks to a new high, probably time to pull the chips off the table. So we can look at Exxon, we can look at the dollar to time our NRGU exit. We're nowhere near exiting that play. All right, here we have the interest rates in oil. I was telling you, before it was looking like this. We had oil going up and rates going down. And I was telling you either the oil's going down or the rates would go up. I did think the rates would go up first, but then we had governments globally coordinate an artificial dump in energy to cool off inflation, all due to politics. And so, wow, look at that. Oil came right down to those rates. So are rates going to zero and the whole economy is going to shatter right now, or are we about to pass spending and those rates are going to go up? As you know, I believe the rates are going up by this dip. Okay, so US trails the European sickness pretty closely, delayed by several weeks. So keeping a close eye on that. I expect that we're going to see a lot of cases going parabolic through mid-February, and this will be the uncertainty the Fed needs to essentially slow down tapering. Carl says, how can the Turkish Lira increase the dollar value worldwide? Yeah, because the whole thing's connected, yeah. And that's the only currency that's losing value to the dollar. Let me pull that up. That's a good point. Rather than just take my word for it, let's pull up a bunch of currencies here and see. Okay, so let's see who's actually losing money against the dollar. So, okay, so we have Brazil is losing a tiny amount compared to the dollar. The peso, our main trading partner, is pretty much even. The Australian dollar is even. The Japanese yen, the Canadian, the ruble, Swiss franc, and the Chinese currencies are all stronger. So yeah, there's really just, of course, we could always pull up the euro, but I mean, that's the pair against DXY. So yeah, the weak link is definitely the lira. Now, the other one that was weak was the South Korean won. So I'm not sure if I have that one on there, but those are the two that are showing. It's really this one. This is the one that stands out, the Turkish lira. So yeah, just imagine that in the last 2 months, if you were not invested in the stock market and you lived in Turkey, your money is worth half as much as it was 2 months ago, and it's not getting better anytime soon. It's now hit 13.76 against the dollar, and again, if we look just 3 months ago, you're getting 7. So just incredible. Very bad for the population of Turkey. I'm not sure how many tens of millions of people live there. I think it's 30 million, but it's just a guess. Okay, so yeah, so that can be contained, but the greedy people are watching to see how much pain, how low can it go? How much blood can be spilled so they can go get it as cheap as possible? But it will be bailed out eventually. And that'll make the dollar come down and our bets against the dollar really pay off. Okay, copper futures would tell us if there's a crash coming. It's hanging in there, no signs of weakness. Some other futures markets. Now, this is what I want to point out. If you're worried about your natural gas play, look at what happened to the lumber futures. So this went crazy from a historical average of 400 to an insanity of 1800, crashed all the way back down. Let me hide natural gas and go to dollar terms. So we're buying somewhere in the falling knife period like this, but look what happened to lumber futures. Went down to 500, 468, and doubled. Okay, doubled. So it's showing you the inflation's not gone. It's just coming in bubbles and little hot spurts. And so we want to buy these inflation plays on the crash, be building into it, and then sell as it breaks into ridiculous new highs. As far as playing some of these not as essential commodities. So oil, again, mainstream play. I'm not going to be jumping in and out of it like I would the natural gas play we're currently in. So now let's just look at the natural gas play. And here we are. Let me zoom in on that so we get a better look at it. And so we can see it's coming back towards that level it was historically at. Maybe it'll touch it, maybe it won't, and I'm expecting it to go right back up. Probably looking for a double or a triple on Boyle and then get out. So look for a trade alert this week to add to Boyle. Okay, Baltic Dry Index is the measurement of how expensive it is to ship commodities to a handful of different continents. Same pattern, went parabolic, nosedived with government interventions trying to scare off inflation, and now it's coming right back. So they're just not able to contain the inflation because they printed tens of trillions of dollars globally while ruining supply chains. So you increase the money and you decrease the supply. So you got more money chasing less goods. What do you think is going to happen to price? All right, here are the bond metrics. And again, we looked at the yield curve just to reinforce this. 2 years telling us this inflation sucks. You're not paying us enough interest. And we've got short duration yields going up rapidly. And this is signaling the Fed needs to hike rates to fight inflation and get these rates where they should be. But the long end of the bond market saying, go for it. You're going to crash everything if you do it. So what does the Fed want to do? Keep the job market alive and the stock market alive? Or do they want to fight off inflation? Because they can't do both. And so that's what the bond market's telling us right here. Gold copper ratio, just to give you perspective, 2002 to 2007 is the period that I think we're going to repeat. So you don't want to be betting the farm on gold and silver. You want to be betting on oil and copper, rare earth metals, things of that nature. And then again, interest rates rose the whole time. So those banks and energy companies outperformed. Okay, here's the 3 critical bond markets. This is what allows cheap credit to go to the government, which I would just think of as the world's biggest company. Then we've got LQD feeding the Apples and Amazons of the world with credit. And then we got junk bonds feeding the Russell 2000. Okay, as long as none of these are crashing, it's very bullish, means they can keep borrowing money and inflating everything. So corporations like to do stock buybacks. The government likes to just dump money into the economy as fast as they possibly can do it. And that's what they do a great job at. All right, so here's where we track auctions. As long as reverse repo is over $1 trillion, I don't care how much money Janet Yellen wants to raise. US is about out of money. They need to get the Treasury account balance towards 800 billion as soon as they can pass the reconciliation bill and sneak the Build Back Better package into it. And so that's when I would expect a risk of interest rates to rise. So we'll watch the auctions flood in as soon as that's passed. But again, McConnell again gave the Democrats a bone instead of making them push some legislation through and face a debt ceiling crisis. Again, he came through and gave them another extension. So I would say he's quite literally an extension of the Democratic Party right now. And that's why we're not betting on a debt ceiling crisis causing volatility when all three branches of government are controlled by the Democratic Party, and the opposition very apparently are on the same team as well. So I expect spending to go through. Okay, non-farm payroll, 210,000 jobs, very weak. To really be able to get away with rate hikes, I believe this needs to be above 700,000 consistently for the next 6 to 12 months. Otherwise, you're going to raise rates in a weak economy and crash everything. Now, interesting, they did revise back the summer months to have these really high job prints. I believe that's on purpose. If the jobs are coming in hot, the government needs to slow down spending and hike interest rates, and that's very bad for growth assets. So who knows if this is being underreported. I believe it will be pretty weak until March, and starting in March, this could start to actually go, and that's going to be based on the seasonality of the sickness, slowing everything down. But I do think once the budget passes, that things could speed up as well. So we'll see how that plays out. Right now, very weak print. Okay, Friday we get the next CPI. I think it's going to be above 4. I'm not sure if it'll go above 4.6. I'm going to bet it's a little bit lower, and that will be good news for slowing down the Fed from tapering quicker. So we'll see how that plays out Friday. Banks are lending. This is growing. This is healthy. This is how we are positioned for banks to take over where the government's going to slow down, and for consumers to borrow, which we're seeing in both these charts. So that's good. Retail sales still strong and growing, and spending still growing, all those slowing down. Jobless claims are starting to get to that range we wanted to see to believe rates are about to rise. So that's been improving. Wages continue to be sticky. Rent will be sticky. Labor force is the problem. So the problem is we got to get back to where we were in January, and it looks like this 5 million spread, they're not coming back. The seniors are not going to go back to work. Their stock portfolio's up, and they're calling it quits. So this is going to force wages higher and be very inflationary. But what do people in retirement have to do with their stocks? They have to sell it to support their income. So this will be very, very interesting. We did get an uptick here, so we'll see if they can get this to start to rise. The financial system is really not situated for a long-term rise in wages or employment. So the worst decade in US history that was long-lasting, slow, and very hard to deal with was a decade of crashing stocks and bonds from 1970 to the 80s. And so for that to happen, I believe we need to see labor improve, wages rise the entire time, and that would keep the inflation difficult to manage. So is that going to happen? I don't think so. I believe we're really in the opposite problem, is that corporations are automating jobs and processes, and then we have too many people, too few jobs, and that this trend will continue to get worse, and that governments will try to keep everybody happy by printing money and giving it out. And so that's why you want to own your inflationary assets, especially the crypto. All right, here's the balance of trade. Again, they call it the twin deficits. If we're going to spend money we don't have and import all our goods, that's good for everybody else, bad for the dollar. That's how we're positioned currently. And again, the dollar's been going straight up. We're still doing great. Wait till that dollar falls. Then you're really going to make some serious money with our current strategy. Some canaries in the coal mine to tell us, hey, watch out, something's wrong. We don't know what it is, but something's wrong. Apple tanking would do the trick. It's not. Tesla, I'm not going to be worried unless it crashes below 800. I would probably give you some sort of bonus trade alert to buy it if it hits 800, and I would be shocked if it goes below 800. Now that's as long as the rates aren't rising. So we'll be giving you a signal to get out of tech once I think rates are on the risk of rising like they did last March. Right now, that's not in the cards in the short term. ARK funds, now poor Kathy Wood's not having the best year. And unfortunately, I don't see a very good pathway for her over the next 5 years, unless she completely changes her investment strategy. So I would not be a holder of ARK funds. I look at this as systemic risk to the markets. There's too much money in here, and it's extremely sensitive to interest rates rising. So keeping a close eye on it. Probably the worst stock we'll look at today. Tencent, a massive software company out of China, holding its ground. Alibaba getting a nice bounce today. Probably two of the best deals in the stock market. Currently, Samsung holding its line here, and Toyota still dominating. So nothing to freak out about. We've got PMIs in positive territory in China, and they're getting ready. They just dropped interest rates by 0.5% and are expected to continue to do so. We've got the European PMI still in positive territory. China imports have slowed down, but still at record levels. If you look at big picture, it's never been better. Their currency's strong, their inflation's low, imports and exports are at record levels. So we like that Asia exposure. It's a little slowdown in exports, again, nothing crazy. Now, if we look at the balance sheets, this has been highly correlated to stock valuations. The higher they go, the more money the government can spend and the more inflated financial assets become. And so a little pullback here, and what'd you get? You got a pullback last week, but guess what? This is still on schedule to break 9 trillion unless they get very aggressive in the December minutes. And as you know, I think they'll do the opposite. ECB still printing. Okay, so that balance sheet's very close to the same level as US. Japan has essentially stopped QE, although it did add a little bit month over month. If we look at our news feed, let's see what headlines we have. We got a new futures product coming in for Ethereum. New York just banned 40% of Americans from going to New York, and 30% of residents not allowed to go through. Just madness. So that'll definitely slow down the recovery. Goldman Sachs predicting a massive gain on the S&P 500 by next year. They're funny. They think that they're going, and usually you want to be careful trusting what banks say, but Goldman Sachs believes the Fed's going to successfully end QE 2 months early, hike rates 3 times, and drive the stock market to 510 on SPY, currently at 458. We've got some Tesla news, nothing to freak out about. Polygon's showing how much more efficient they are compared to Ethereum in terms of carbon print. That's a layer 2 solution, which we have exposure to for Rebel. Cardano's getting ready to launch its decentralized exchange, which we're going to participate in for. So what's going to really happen when we do that? We're going to own Cardano, and we're going to own it against all the hot new software applications coming out. So we'll be letting people flip between those pairs. We'll be getting to collect transaction fees and having exposure to Cardano plus all the hot applications coming out on its blockchain. So really neat way to generate income and have a much more aggressive play than you do with the high risk strategy. And again, we want to own assets in Rebel that are not in the stock market. That means you're front running the whole stock market once it hits global platforms. So that's what I can do for you and provide value. German factory orders slumped, but again, we know that China has been doing things to slow down inflation, redistribute wealth, and it's all been done with the eye of having a more efficient economy and society long term. Now, do I like the communists? You all know I despise them, but does that mean I think they have a bad business model? Not necessarily. So that's why we have in the portfolio. My job is to make you money. So far, the data on this new variant is that it's it's twice the spread of the Delta, but so far it's not making people sick. I guess it's picked up characteristics of the common cold. So very funny. And we called BS on that news. Here's a look at subway traffic in New York. Nowhere near where it was. Wow. So one of the worst recoveries so far is in the subway traffic in New York. Mandates out the gazoo. This was news. It did happen actually. They did lower the interest rates, and they're going to continue. It looks like Israel's now announcing the 4th mandated medicine. So how many are people going to take? The 3rd one's not having a high uptake. I think people are starting to really question, why is this not working? Why do I have to keep taking this medicine over and over and over again? And again, that's slowing down everything in terms of recovery. Chai Girl says EV batteries require a lot of industrial metals and minerals. Mining for these requires a ton of fossil fuels. The technology is just not there to make these net zero in the real sense, not in the I'm a carbon credit trading Tesla company sense. Housing costs going up and used vehicles. So that this is a person I like to follow, Lynn Alden, and basically she's predicting the CPI is going to be pretty hot Friday and for a while due to this. Gunlack was saying their models indicate removing QE is equivalent of 200 basis points of tightening plus 4 hikes. Yeah, I don't think they can pull this off. Okay, very good. That does conclude the headlines I wanted to focus on. So we will do a review of the asset allocation and get everybody out a little early today. So let me head over to that. And also, this is where the replay version ends. So if you're watching this as an advertisement on YouTube, you're going to miss out on the trade alert. So don't forget to call Dean to upgrade and gain access. Okay, guys, so we're going to go ahead and close the remarketing one and go into the paid only content next. Okay, so let's go ahead and end that.